And we're live.
All right, guys, we're live. All right, guys. Thanks for. We're gonna give everybody a few minutes to join in. It's gonna like go from 0 to like 50 to 100 people in the next like probably 5 minutes. For now, let's just start with introductions. For anybody who doesn't know me, my name is Nick. Um, I run the New Jersey, New York, and Philadelphia Real Estate Investors Expo. I also do business in the three states, and so because of that, I'm pretty busy normally, but at the same time, I love helping people get into the business of real estate investing. And so because of that, we do these events once a week, every week around 12 on Thursdays. So if you enjoyed today's segment, definitely join next week. Um, Dave is a business partner of mine, Dave Tran. I work with him, and Dave his handles everything for me in the Philadelphia area. But tell him about yourself, Dave.
I'm David Tran, and I've done real estate investing, fixing, flipping, do a lot of wholesaling. Now I'm doing a lot of personal development coaching, just helping people with life and their personal struggles and a lot of their emotions. So that's what I'm doing a lot now. So yeah, I got all my businesses, and I also own multiple businesses, beauty businesses. So I'm all around, just doing all different things, exploring different businesses. So that's pretty much me in a nutshell.
Yeah, I think a lot of people don't know that you're like the people in real estate know you're in real estate, and the people that in your beauty business only know you're in the beauty business, right? Uh, they don't actually know that you have like a bunch of nail salons and so.
Yeah, people don't know that I have different lives.
Yeah,
A lot of different lives, and that's how I like to live life. I like to explore different things, and that's what I like to share with people too. Like, how can they do more than one thing in one lifetime? Yet focus on one thing, finish, and do more, and stack on top. So
along with us, we have it's AJ, or as you want me to call you Albert.
AJ's fine.
Okay, AJ Campo. He's the CPA, guest CPA, special guest for today's event. Our event today is on, the topic was on like breaking down Trump's tax returns, right? But like, I was looking through it. I was looking like through other people's explanation videos of it, and then after a period of like a few hours watching all these videos and stuff like that, I realized like we actually don't care about his tax returns, right? We really, it's more about how do we figure out, or what can we learn from it, if anything, so that way we can use some of the strategies that he's used to uh, make our tax returns better or make our income tax lower. And so that's why we're going to get into that deeper. But before we do, I want AJ to tell us about himself. So AJ.
Okay, so thank you very much, guys, for having me on today. So I'm a CPA in New York and New Jersey. Been CPA for about 10 years now. So started with Big Four and kind of trickled my way down to now have my own practice. I have a staff person that works with me. So we deal with individuals, small and medium-sized businesses. We cover the gamut in terms of services between payroll, bookkeeping, what have you, LLC creation, and consulting, in various ways for business valuations and whatnot. So we're very multifaceted here.
Awesome. So you mentioned a point about LLC creation. I think that's a great place to start, because a lot of people they hire a lawyer to create an LLC or a corp or whatever it is, but I think a lawyer is just really an expert at like making it safe or legal for them, things like that. But in terms of tax advice, lawyers are I don't know. They don't but what are your thoughts on that?
I mean, lawyers are great resources, obviously. A lawyer or a qualified CPA can set up the LLC, get your federal EIN, and set you up for New Jersey state tax purposes. We work with an attorney that does, when we create an LLC, we'll kind of do the creation and the setup, what have you. But then when it comes to articles of incorporation, and operating agreements and things like that, we work with an attorney that will set that up. That's not, that's above our pay grade. We would be doing our clients a disservice if we were also offering that. Plus, we're not qualified to, be offering legal advice. We are accountants. We can, at least talk to the tax implications of an LLC versus an S corp, C corp, what have you. So we do work hand in hand when it comes to those type of things. But again, we have a lot of our clients come to us, we set up LLCs for them, especially with real estate. We always recommend that, so each property that you do own is in its own LLC. And then, we also work with an insurance person, again, because you need liability coverage, umbrella insurance, a lot of things come into play, because you don't want one of your properties, one of your tenants to sue you in one property, then all your other properties are at risk. So you want to make sure you're covered from a liability perspective as well. I know you initially, kind of mentioned, LLCs versus S corps and C corps. So when it comes to real estate, corps are not the ideal entity for you to be owning rental real estate. Main reason being because there's a lot of tax implications. It's not easy to move assets in and out of a corp. For example, say, Nick and Dave both set up an S corp. You buy a rental property, but something goes south. Dave says, I'm going to take over the property. You guys sort everything out. Technically the property wasn't sold, but because the property is moving out of the corp, it's considered a deemed sale. So you have to pay tax at the time of that transfer. Versus an LLC, you can more easily move assets in and out of a partnership 1065 structure. So that's why LLCs are more advantageous when it comes to owning properties. S corps can play a factor. Again, we have clients that are considered real estate investors, real estate professionals. So they'll set up, say, a management company where the rental properties will pay an S corp management fees, and then from that management structure, the S corp, the owner will then pay themselves wages, W-2s. They'll pull money out of the entity that way. So again, there's a lot of ways that you can really structure it.
So you advise that for a person who like multiple households, every property should be under its own LLC, and that way it has its own EIN, it has its own bank account, and then from there, it builds its own bank account or bank reserves and all that. And then when tax season comes, we're in essence giving you accounting for pretty much each LLC.
Correct, and it does make it easier. Again, if versus just getting a spreadsheet with this is everything, it does complicate the prep. So if you have everything segregated and at least you're using everything in its own LLC, just to kind of circle back to that. So just because the property is an LLC doesn't mean that property has to file a tax return. So single member LLCs, one owner, are considered disregarded for tax purposes. Right. So they go on your Schedule E or your Schedule C. So, you could have 30 properties and 30 LLCs. You'll have a very big 1040 return with a lot of Schedule E's. So that's kind of more or less how to explain that. But yeah, definitely we always recommend, some sort of accounting software. We have helped clients with, say, setting up QuickBooks with asset classes and things like that to better track those things. There's other ways to do it, but definitely keep everything separate, your own bank accounts, your own things like that, which would, again, make it a lot easier for everyone, come tax time.
Okay, I was following, so don't worry.
Yeah, no worries.
AJ, I want to ask you this. So I hear that LLCs are very popular in this field. Do you ever see people using trust to hold properties, and then the trust has an EIN and it has its own account?
I haven't dealt with trusts when it comes to real estate investors. Trusts really matter more when it comes to kind of succession planning and more family transition of assets. Again, you can move your primary home into a trust. And we do trust work, but it is on a relatively limited basis. Trusts are a completely different animal. We also work with a specialist, an attorney who specializes in trusts. We can file the returns, but when it comes to setting up the trust docs and things like that, again, that's above our pay grade. We always refer that out. But we are involved in those discussions. But when it comes to real estate professionals, I haven't seen anything, at least personally yet, not to say that it's not possible, of moving rental real estate assets to a trust. But again, when it comes to assets and things like that and who's going to get it, probate issues, definitely having a will, that that's more kind of personal planning, tax planning, things like that come into play.
The only reason why I asked is because I don't see it being very popular in New Jersey or even New York, but I see people using it in the PA area,
Okay.
and it's not even for they do it for anonymity more than anything.
Right.
But yeah, I just wanted to know, like, because I'm sure you've seen a lot of investors, tax returns and Schedule E's. You would see, like, if they're using LLCs or trusts. I'm finding that a lot of people in New Jersey use LLCs more than anything.
Yeah, I mean, LLCs in general just make sense, not just exclusive to New Jersey. Like I said, you just
Right.
want at least some basic liability protection for the assets, so your personal assets aren't at risk. Again, then insurance comes in play. Liability coverage, making sure those are up to par, and then having just an umbrella policy as well to cover, kick in on top of that. You don't want, again, like I said, one of your tenants suing you, and then all of your other properties are at risk. Again, everyone's worked very hard to acquire and build a portfolio of assets. You don't want to lose it all just because of one person or one lawsuit. So again, that's when insurance is very crucial when it comes to that. Just having an LLC isn't the end all be all. It's not just, all right, I have an LLC, I'm completely protected. That's not entirely true.
Got it. Dave, you have any questions you want to ask?
Yeah, I do have a question. Like you said that each LLC should have one property. Like I said, I heard before that if you do that, you will have too many LLCs, and if you're not good at managing LLCs, like it's going to cost a fortune when it comes, time to hire accountants. Is that true or not true? Is that a myth?
I wouldn't say it's a myth. I mean, we do price for our services. We are good at what we do, and we are compensated accordingly. I have seen returns that just, some people traditionally the saying goes, you get what you pay for, right? And that's true for the most part. Something that I always at least tell my clients is taxes are the biggest expense of your entire lifetime. So nickel and diming for a tax preparer, a good CPA, shouldn't be your first priority. Again, if clients call us and they immediately start asking what our fees are, they may not be a good fit for us, because again, if you're just price shopping, then again, you may not see the value that we can bring.
Well, not just for price shopping, but also for someone like, let's say myself, that does everything myself. I'm not an accountant, and I'm trying to make it simple for myself.
Right. Right. No, I mean, we offer, again, bookkeeping services, things like that, again, to kind of take that kind of headache off of you. So again, you want to focus on the business, and that's again how what we do with our clients. You focus on running your business. We'll focus on being kind of more the outsourced accounting group for you. Whatever we have to structure, but we'll pay your bills, we'll do the bookkeeping, we'll do all that, we'll handle it. So come tax time, it's a much simpler handoff versus here's 12 months of bank statements. I have 13 properties. Godspeed. So again, it's all a matter of how to set up and provide those services to the client. Because again, if you have 2 or 3 properties, it's not terrible. But again, we have clients with 13 properties on their personal return, plus they have 4 or 5 partnerships for each of those own 5 or 6 properties. So now we're talking 25 rental properties, and the bookkeeping and stuff like that can get very tedious. So again, we get involved on a monthly basis to make sure that's kind of done appropriately. So it doesn't become a big headache.
I just want to review what you said. So what you said is that one, a lot of the investors that invest in real estate, they hold properties under LLC. They each have their own accounts, bank account, EIN, all that. And once a person starts building a larger portfolio, 10 units or more, 10 buildings or more, or a certain cash flow, like probably netting at least 10,000 or more, they start looking into things such as getting a bookkeeping assistance. Is that right? But
I mean, there's no magical rental property number. I mean,
right.
Sometimes you could have 3 properties, and it's these aren't real estate professionals, but it's regular regular people have 9 to 5 jobs, and they got a family, and you have kids, and just like, I can't do this. Even at 3 rental properties, they are actively involved. They are the landlord. They're getting calls to deal with that, and on top of dealing with all the financial stuff, again, we'll still do that for 3 clients. And we'll work with you on those things as well. So, I'm sorry, with 3 rental properties. So again, like I said, we'll work with you as well on that. But again, we're here to be we're here to serve as an advisor and kind of make everyone's life easier. Because if I'm making your life easier, then in turn, my life's easier. and
Right.
everything's done much more efficiently.
The only reason why I said it like that was because, like, for me, I was lucky when I got into this business. I have a partner. It's pretty much my wife, and she does that side of it. So,
Right. Right,
but,
and we have clients that have that as well. They have a spouse or something that's just doing
right.
that full time, and that's fine.
What I'm saying is, like, I didn't know that it was super important to have somebody like that on the team. And so for people that don't necessarily they're not married, they're single, or they're not good with numbers, right? It would be very, very important. It would be very, very important to realize that they can just partner with an accountant and do bookkeeping, not partner, hire.
Exactly. I mean, the one thing to at least, I guess, kind of drive is that, don't underestimate the value of a good CPA and the service that they can provide. Again, if it can make your life easier, look, I got a family. I would, I try to make my practice also easier so I can enjoy time with my family and things like that. So that should apply for all our clients. Again, if whatever you're involved in, we're here to provide a service and make sure, you're getting the right advice and you're able to kind of focus on things you want to focus on. If you want to focus on your business, but at the end of the day, who wants to do bookkeeping at 10 o'clock at night? Nobody does. Nobody.
Right.
So again, that's where we can come into play and then at least advise you how to kind of handle those things for the properties. Again, something comes up like, look, I'm looking to do this improvement or that improvement. How should I do these things? What have you? So we have a lot of those ongoing conversations with our clients.
Let's go to the next point. Becoming bankable or seeing people like kind of zero out their income. So I was, can you explain what those each means, and then what do you see people doing?
So I was a little confused. What do you mean by bankable? Just mean
okay, yeah. So it's a term that I'm aware of through this, because in the real estate investor space, right? There's people that don't show their income, like they try to zero out their income every year.
Right.
And because of that, the banks don't want to lend you money because they're like, oh, you're not making any money. Why am I going to lend you money? And then, so because of that experience and going through that, I learned that I had to actually show that I'm making money, and then I have to pay taxes on that because I'm showing that I'm making money. But the benefit of that is the banks now want to lend. So is there a way to do it where I can minimize my tax like my tax payout and still be bankable?
Yeah, I mean, again, look, the way banks really should be looking at this and are hopefully looking at this really are, we're looking at properties, you have a ton of properties, there are tax expenses that aren't, real, they're not real world cash flow items. Again, depreciation is a tax item.
Right.
That's not physically coming out of your pocket, but it is potentially, most likely, hopefully, putting you in a loss position. So again, when hopefully banks are looking at these things, those are kind of add back items to see, are you still truly netting positive cash flow? Because at the end of the day, like any corporations focus on EBITDA, earnings before interest, tax. Again, you want to focus on true profit before kind of other items trickle in and things like that. I don't always suggest trying to zero out your income because, again, like you said, it's kind of like the Trump mentality. Everyone's like, oh, okay, well, he's a genius, whatever. But you're spending as much as you make. So how are you surviving? And those are the other things. Again, very broad kind of description, but yeah, I mean, again, being bankable. Again, like I said, there's ways to structure these things. Again, if you want to have a management company, depending on the entities you have, you can at least pull wages, pull a W-2, show something on paper. At least that way, kind of contribute to Social Security. That's kind of ties in with retirement planning and things like that. Which could at least help. Also, of course, the more assets you own, I'm sure you can find a bank that's willing to lend to you. If you own 5 or 6 properties, there's a net worth there, no matter what, even if you're showing a tax loss.
I mean, there's banks that or institutions that will lend to us. It's just that because we're not considered bankable, or I wasn't for a period. What I realized is that I had to pay 1% more than whatever the market was. And so I thought that was just my cost of doing business.
Right.
But then as time went by, I realized that the rates I can get being bankable was actually drastically less. And from that, I started transitioning over, but that also takes like 2 years to transition, because then you got to have the books to show for 2 years.
Right. Most banks want to see at least 2 years of self-employment income, business returns, things like that.
Yeah.
Especially in this climate, it's probably more difficult. Banks are now kind of tightening the belt a little, more, so to speak, now with the pandemic going on this year. A lot of factors have played into that, but yeah, no, I agree. I mean, like I said, there's ways to at least set it up so you can kind of appear bankable, and there's other. Again, it all depends. Dave is in real estate. He's got other businesses as well, so there's more facets to his financial picture of being bankable versus someone who just owns real estate. So.
Right. Yeah, because it's really interesting because, I personally have friends that have hundreds of units, and they weren't bankable for years. They're like, what, I gotta reorganize this.
Yeah, like I said, there's ways to structure it so you can at least pull some money out.
Right.
Of the underlying entity. Yeah, of course they have cash, but
income, like taxable income. So we can't lend to you.
Right. And then one thing I do want to address, because I have seen it, and there's kind of a somewhat misnomer about it in the real estate arena, is this whole thing about holding companies. I have seen people being advised of setting up holding companies while they only own one rental property or two rental properties. Holding companies, really only make sense in certain situations. So if someone just starts telling you should open up a holding company, do some due diligence. Maybe talk to someone else, because that isn't always the best avenue or makes sense. Why create another LLC when it's not going to really serve you any purpose?
Right.
So I just kind of wanted to throw that out there.
So you it's like a shell, right?
Right.
I even set up a shell until you actually need it, is what you're saying.
Right.
Okay.
It's like a shell per se, but again, if you have a bunch of LLCs, you have a bunch of rental properties. Again, it all depends on the structure. If you're bringing someone else into play, again, say Nick, you have properties you're going to contribute. Dave is contributing some other type of sweat equity. You can set up a holding company at least to kind of pool those assets together, pull them off as Schedule E. There's other implications as well when it comes to carryover losses and what have you. I'm just talking at a high level, how that would make sense.
Got it.
Yeah, because it wouldn't be, you have carryover losses. Those wouldn't shift from your personal return to the holding company. Those actually stay suspended on your personal return.
Right. I want to go to the next point. People that have these, so all these LLCs, this guy got like 10 properties, I got 10 LLCs. From there, that income is going to eventually flow back somewhere, right? Do you set up an LLC for it all flow back into, or does the money actually stay in each of the LLCs? And how do you structure that?
What do you mean? Like just like cash flow staying at each LLC level?
Yeah. Like, so is the LLC holding the property, the cash flow that's going in there from the rental income, does it sit in there? Right. And then from there, how does it transition to you? Is my question. Do you just with?
It really depends on what the objective of the client is. Are they looking to, improve the property that you can put it back into the property, or you could just take the money out per se. It's an LLC. In terms of distributions per se, you could really just pull the money out. You just want to make sure you at least have some sort of cash flow, some sort of, backup there that, God forbid something happens, you're not having to then start borrowing money from your other LLC accounts.
Okay.
So you just want to make sure to be smart about that. But again, if you have an excess surplus, again, at a high level, the depreciation expense that you get on your return is theoretically tax-free money to you. So
right.
You could almost take that out. You're not going to pay tax on it, really until you sell the property or you 1031 it or what have you. And ultimately, at some point, you'll pay the tax. But, again, that's all tax planning as well.
Actually, yeah. I think since you're talking about that, since you're saying it, so when you sell the property, what's the percent that you actually pay in terms of the depreciation? Because you
none. So the 1250 recapture really doesn't come into play unless it's qualified improvement property. So qualified improvement property, which actually was just corrected under the CARES Act. So if you're flooring, something like that, which is typically depreciated over 27.5 years, you can then start depreciating over 15 years. But anything depreciated straight line, even though it is structural, is not subject to 1250 recapture.
Oh, okay, I see.
So you would only come into play with 1245 recapture. Those are your assets if you had, furniture, fixtures, equipment, things like that in there. And if you sell them for more than, the basis in there. If you sell them at a loss, then there is no recapture.
I see.
It's not considered it's not considered a hot asset.
Right.
Anything depreciated straight line is not going to be subject to 1250 recapture. So, you sell the property itself, the depreciation you got on that is not subject to the 25%. If you sell it at a profit, then yes, depending on how long you owned it, would dictate if you're going to pay ordinary income tax or long-term capital gains.
Okay, this is a great time to transition to fix and flip. Because with fix and flip, I think you're going to be paying ordinary income tax versus long-term.
That's the goal. You definitely don't want to get into a flip and be holding on to it for over 12 months.
Yeah, that's true too. But I guess my question is there a so I think you just answered it. So if you're doing fix and flip, unless you have really cheap cost of capital, right? You don't want to hold it over a period of 1 year. Is that correct?
I mean, theoretically, again, it comes down to kind of a tax planning perspective. Like, all right, what's your foreseeable gain on this? And then, so what's your time horizon? Can you sit on it? Does it make sense to sit on it?
Right.
More often than not, it doesn't. But again, there are situations where it could make sense where you hold on to it for at least 12 months or 1 day and only pay, 15%, on it versus whatever your ordinary income rate is. But again, it's very nuanced. It's very specific to each client, so it depends. We'll have to have those conversations with our client.
So I'm gonna sum it up because I think you shared something that a lot of people might not be aware of. One is if you have if you're using hard money, if you're using things that require you to hurry up and finish the transaction, right? Then yes, get it done within 12 months. As long as just make sure that the numbers make sense to take advantage of it, get it done, make your money, and pay the higher capital gains tax, right? But if you
you're paying ordinary tax, yeah. But again, you have a lot of guys with hard money that if a hard money loans, you're paying sizable amount of interest. You definitely want to get in and out of that, unless you have a really good relationship with the bank. So yeah, sorry I cut you off. I apologize.
No problem. You can cut me off anytime because I want you to correct me when I'm saying the wrong words.
Yeah, that's fine.
When you're doing something like, let's say, like with a low interest rate loan or even your own capital, because of that, in a way, you're paying a lot less for this working capital. You have the opportunity to drag it out for a year and 1 day. Yeah. And if one was to do that, let's say one could do that, and closing it on the 11th month versus closing it on the 13th month, meaning what is the tax difference in terms of savings?
Again, your long-term capital gains long-term capital gains are taxed at 0, 15, or 20. Depending on what your overall income bracket is. Again, you could also strategize where if this is your only income, you could almost pay no capital gains tax on it as long as you're under that threshold. I forgot what it is off the top of my head. 1 week before deadline, it's crazy. But again, with ordinary income taxes, you're going to pay your whatever your ordinary rate is at that time. So if you're an effective 22% effective rate, or if you're an 18% effective rate, that's what you're effectively going to pay on that money. And kind of just circle back to clarify that with the 1250 recapture under the current tax law, so the Tax Cuts and Jobs Act, and with the CARES Act fix, qualified improvement property, so anything 20 years and under of its depreciable life can be immediately expensed. So while you would put flooring in and things like that, you could immediately expense that, get a benefit for it. When you go to sell it, those items would then be subject to 1250 recapture, but not the structural part of the building, which is the bigger expense.
So I get it. So let's move to the next point. So next point is gonna be for commercial. I think the residential properties is the depreciation window or is shorter than commercial. I think commercial is like 39.
39 and a half, yeah.
Yeah, 39 and a half, and residential is 27 and a half.
And a half, yeah.
Could you
39.
could you like, I know we've used the word depreciation a lot. I'm familiar with it. I'm sure so is Dave. But just for the audience members that are tuned in, can you give us an example of what that means, so that way they for people that understand, they can understand it. So that
For
way,
depreciation?
yeah, like
Yeah, I mean, and you kind of almost even like, we kind of, discuss it even on the layout here. Again, if you have a building, you pay $300,000 for it. Typically we'll look at the what the municipality is assessing on it, land versus building, and we'll apply that to whatever your actual basis is on the purchase. And land isn't depreciable, so pay $300,000. Let's say for argument's sake, $50,000 of it is land, so $250 of it is your depreciation, is your building depreciation. That number divided by 27 and a half years is your depreciation expense every year. That's what you're getting as an additional haircut, and as a tax benefit, which you're theoretically not paying income taxes on.
I just want to say, so what that means is if that property that you just bought or that investment you just bought is making, let's say, $10,000 net for you a year, right? In essence,
Right.
you don't have to pay because of the numbers that we just did. In essence, you don't have to pay like $9,000 of that, or $9,000 is not going to be accounted for in terms of tax.
Right.
that
I mean,
correct?
whatever the depreciation, whatever the number works out to. So, the 250 divided by 27 and a half.
Right.
Again, if after all your expenses and your rental income, you're at still a net profit of 10, take off your depreciation, and that's just what you're either it'll put you in a loss or at a break even, or less of a profit to pay tax on.
Right. Okay, so I'm gonna invite people to ask questions now, and then I'm gonna read it off to you, Albert, AJ,
Mm-hmm.
and then you can take a minute to just like answer it, because we have a lot already that has been coming in since we started. So I'm just gonna I'm gonna ask you those first. But before I actually do you want to say, or is there anything else that I might have not asked you that you want to point out before we get into the Q&A questions?
Yeah. So the one thing that I did want to kind of circle back on is, real estate professionals versus just, real estate, owners in general. So by nature, the Internal Revenue Code considers rental real estate passive by nature. So there is a section in the Internal Revenue Code, section 469, actually, subsection 7, that would technically allow an individual to qualify as a real estate professional, which would, as long as you meet the tests, the hour tests. The hour test is per property. You have to materially participate on a per property basis, track your hours, all those other things. You could then, those passive losses would then become active. So you could take them as an active loss. So let's say, a married couple, one of them is considered a real estate professional, and someone is a high wage earner W-2. Those rental losses could then go to offset the W-2 income. So there could be significant tax savings there. However, the criteria there is very restrictive. So again, those are on a case-by-case basis when it comes to discussing with clients. Another kind of caveat is that, someone who owns, say, 2 rental properties, you have a W-2 job, you're the landlord, you don't have a management company handling it, but you're actively involved, you're fielding the calls, you're going to the properties, doing all those things. You are still technically materially participating. So as long as your AGI income is under $150,000, you're able to then get a real-time benefit of up to $25,000 in rental real estate losses on your current year tax return. So you don't have to be considered a real estate professional, but you could still get some losses. The losses are capped, assuming your income is under a certain threshold, and they're capped at $25,000. But again, that's just kind of high level what I wanted to at least kind of mention, because we do get those questions like, well, you know, I own 2 properties. I'm a real estate professional. Unfortunately, you're not, most likely. So.
Great, thank you. All right, I'm gonna post up the first question. Why should one put one property, or why should I put one property per LLC compared to properties in one LLC? Is it more a tax a strategy or a asset protection strategy?
It's an asset. It's more an asset protection strategy. Again, if you, you know, again, we have partnerships that, you know, all right, it's, you know, XYZ LLC, and they own 5 properties. You know, depending on how the insurance is structured, if one of your tenants sues you at one property, all the properties in a portfolio are at risk, because they're technically all under one operating asset.
Right.
So again, that's when, you know, potentially a holding company comes into play. But, you know, look, for the $75 a year to New Jersey, it's just smart to do. You don't have to file an extra tax return. You file an annual report for the $75, and then at least you're getting that at least somewhat of an, you know, asset protection.
Great. All right, let's go to the next question. If you had 5 to 10 properties, each one with an LLC, would you want to create an umbrella LLC or to group them together, or do you just keep them all separate?
That kind of ties in with the whole holding company thing. I mean, again, if you personally own 10 properties, you don't need a holding company. It just makes no sense. It's just
that's really interesting. I'm sorry, keep going.
No, I'm saying it just doesn't make sense, because you own the properties. I mean, a holding company, again, if it's just you, it's a single member LLC. So there's no other way for it to report on your personal return. Holding companies only make sense when, say, 2 people want to come together. Like, you know, look, you own 2 properties, you know, Dave owns 3 properties. You want to at least put them together. All right, we could then form a holding company where then those are kind of, you know, lumped together. You can then, like, okay, we want to then now do business together. All right, fine. You know, and then you want to start maybe acquiring new properties, what have you. So at least those K1s are then kind of reporting the return. But if you personally, individually own, you know, rental properties in general, you know, more than 2, 5, 10, 30, holding companies don't make sense.
Got it. That's a deep answer, because the reason why it's a question that keeps coming up, mainly because there's so many people that teaches you, okay, you can have an LLC holding each property, you have a company that holds all the LLC. But what you're saying is, it's the same thing as if you're the only owner. It's what you're saying.
Exactly. Every time we get a new client or anything that calls us, I literally want to bash my head through a wall, because I don't know who's advising them and telling them that, but it doesn't make sense. You know, like, okay, I could own 1,000 properties. I'm not going to set up another single member LLC, because it's disregarded for tax purposes. You can't report it. It could go on your personal return anyway. So
this is why, like, because I even asked you earlier the same question. But I like phrased it in a weird way, and then you're like, I saw that you were confused that I even thought of that. But I'm glad
we get it all the time. We hear it all the time. I even went down a rabbit hole to research. Am I missing something? Is there some mystical tax loophole that I'm missing? And no, it just doesn't make sense for a single, you know, an individual who owns multiple properties to set up a holding company. Doesn't make sense.
Yeah, no, I get it now, and you're right. Like, this is a big topic.
Yeah, it's like a huge thing, and I feel like it's been this pitch that's been sold to the real estate industry, you know, investors and things like that. I'm like, again, only in certain situations will that make sense, but for the most part, it doesn't.
So you said it just now. You answered it. Are there any times that a holding company is needed? That's when you're doing a partnership, more than one member, and you're.
Yeah, I mean, it's typically when there's multiple members, and then say when 2 parties want to come together, you know, for, you know, a collective business. You know, again, like I said, if both of you own your own respective properties, you want to then, you know, put them into an LLC. You know, you could do that. Like I said, they come off your personal returns. They then get reported at at the partnership level, you can then acquire more properties under the partnership structure, but that could theoretically be considered a holding company. Theoretically.
Right. Okay, so I want to review some of the stuff you shared with us. Actually, pretty much the whole thing, so that way it allows me to make sure that I got what you shared, and so for anybody that doesn't get it, they can hear it as well. Okay, so what you're saying is, if you're in the business of real estate investing, LLCs are the way to go. And if you're going to be buying long-term properties to hold, putting them under a single individual LLCs is important. You can set up an EIN, a bank account for them as well, and then when tax season comes, just doing the Schedule E, not doing Schedule Cs, instead doing Schedule Es.
Well, Schedule Cs come into play when it comes to the fix and flip.
Okay.
Wholesalers, for example, are a Schedule C item. So, if you're wholesaling, again, that's a Schedule C. And fix and flips could be a Schedule C, or they're a Schedule D item. Again, if you are in the business of doing fix and flips, if you're doing 1 or 2 a year, the IRS could then consider you to be in the business of doing that.
Right.
Right. Dealer. You have to then, report your inventory at the end of the year. You are paying self-employment tax on that. So again, it's, from a tax perspective, it has pretty big implications. If you're flipping 4 to 5 homes a year, that's a Schedule C. You're paying self-employment tax on it. There's other things that we can do, in terms of maybe some other retirement planning and things like that to try to, lessen the tax hit. But again, those are a lot of nuances that a lot of people maybe not understand when they're getting into it. Like, all right, I have 3 properties, I'm going to flip all of them this year. You're not just I woke up one day, I wanted to do one, all right, I did it, I'm done. It is what it is.
So in terms of long-term hold properties, you're gonna be doing Schedule Es. If you're doing flips, you're gonna be doing Schedule Cs or Ds.
Correct.
And the real way of making or getting tax less with long-term holds is by depreciating it over the period of 27.5 years. As for saving or getting a reduced tax on fix and flips, it's either you have cheap capital, and because of that, you can hold it over a year and 1 day, or you just got to do your business and get out. Meaning, flip makes it's cost of doing business, and you're gonna,
I mean, but still with fix and flips, even if you have low cost of capital, if you're doing realistically more than one, Schedule C. So again, it's these are all very nuanced conversations. How many you're doing and things like that. Something else I did want to mention, because I have seen it, is new clients have come to us where they have multiple rental properties and there's no depreciation being taken on the properties.
Right.
None. I can't think of a reason why someone wouldn't take depreciation when it is a tax benefit everyone's entitled to. Aside from the fact that maybe that person thought, okay, I'm going to maybe help save them tax when they go to sell the property. That's not true. The IRS views depreciation as a use it or lose it. So if you don't take it, it's presumed to have been taken when you go to calculate the sale of a rental property. There is a workaround for it though. So let's say all right, I'm just looking at my tax returns. My accountant never took depreciation. That's terrible advice. Can we fix it? Yes, you don't have to amend returns or something called a 481A adjustment. We pretty much have to recalculate the depreciation that you were entitled to for the length of time that you own the property, and then report one big massive depreciation adjustment on your current year return. So that at least most likely would be suspended because, like I said, rental by nature, rental activity is passive. But at least you would at least get that benefit, into the future as well. Because again, at some point, depending on how long you own the property, the scales can tip. At that point, like, all right, depreciation is now low enough. I can now really squeeze more rental income out of these properties. So now you're probably be trending higher. If you have these suspended carryovers, that could then also help to offset future income as well.
Is there a window? Because I have actually personally experienced that, and it was probably because my dad did my tax returns, and and as time went by, I built a bigger portfolio, and now I have an actual accountant. But like, is there a window of how far you can go back, or you said it just now? It's as far as back.
Yeah, I'm not really. I don't think there is a defined window, but again, like I said, when you are doing a 41 adjustment, it is a pretty involved calculation. The process in itself is relatively involved as well from an IRS perspective. But again, we'd have to just kind of recalculate everything. But that also assumes that the client or the taxpayer has adequate records to support it. Versus okay, this is the closing disclosure I had from when I bought it. These are a list and receipts and proof of everything I've put into the property and everything else, so we can properly calculate what the depreciation you would have been entitled to over the years. Because that calculation has to be attached with the adjustment that goes on your return. We can't just say, yeah, I probably should have gotten 100 grand of depreciation, so I'm going to take that as an expense. No, the IRS wants to see the reasoning and the logic and the numbers behind it. So it is an involved process, but it would save, it could save, a ton of money. Cost seg studies are a big thing that are still being pushed in the real estate area as well. Those could also save a ton of money. Cost segs really kind of come into play with more syndication deals. You're not really going to do a big cost seg study if you're just buying one or two rental properties. But it comes into play also, you're buying a commercial building and you're retrofitting that for a business, whatever it is. You would then do a cost seg study for that as well.
There's actually a lot of questions on here, but like, because I don't understand the question, I'm afraid to ask you, because then if you don't understand it either, it's gonna get weird. What I want to do is I want to allow people to, in a way, no, like I want to ask, if you want them to email you, because I think these people actually have like like real concerning questions that are personal, and
right.
And so I want to put up your email. So I'm gonna do that in a second, but I'm gonna ask the next question, and then I'm gonna put up the email. Okay. Can you clarify protections offered by LLC? If the properties are in individual LLCs, what prevents the creditors from going after your personal assets and other properties? If I slip and fall on your sidewalk, this is more like an asset protection question, I think.
Right.
I would probably sue the LLC and owners all and go all assets you own if the individual LLC do not cover all losses. Yeah, this is more an asset protection. Go ahead.
It is. I mean, again, this is where the lawyers come into play when it comes to these things as well. Again, I can speak to it. I'm not an attorney, but again, when it comes to those things, again, there are certain issues where you can pierce the corporate veil at the LLC level. But again, that's where the umbrella coverage and these other items come into play, so that your other properties aren't at risk. Again, I've worked with my insurance broker on that. Again, he's the one who handles all the insurance needs for my clients when it comes to that. Again, you're gonna have liability coverage. There's a slip and fall. Someone, if they know you own multiple properties, they're gonna try to go after it. I'm not gonna say that your other rental properties are completely immune. But again, you have to structure yourself correctly, at least get each property in LLC, so at least only that property is initially at risk. You have liability coverage, liability insurance. You have an umbrella policy as well to kick in. Most people should have at least $1 million of umbrella, coverage, no matter what. So at least, once the liability is exhausted, because then it could trickle into the other properties, your umbrella then kicks in, so that your other properties are still, protected. But again, that might not be a complete answer. That would be more, again, a little bit more of an in-depth lawyer question.
AJ, is it okay if I review your email for people?
Yeah, sure.
Okay, great. I want to do it before you get bombarded, because typically we get a lot of people watching and they're gonna email you.
Just a caveat, deadline is next Thursday. You can email me. I may not get to you until at least next week. So.
No, that's good. That's a good point. That's a good point. We got like a few more minutes. I'm just gonna keep you on for like 4 more minutes, because I know you got to get back to helping a lot of people. I think I want to ask you this question. This is a personal question. When I first started, I didn't have that much money, and that's why my dad was my accountant, right? What is your like should people be reaching out to an accountant to kind of plan, or come up with a plan before they start a business, or do they start it and then make some money and figure it out after and clean up the mess?
I mean, definitely. I mean, we are, accountants are, everything. If you're starting a business, it's a team effort. You're going to have people you trust and work with. So we're part of that team. We're there as a resource. We're there as an advisor. You're looking to start a business, you should definitely talk to an accountant first. Structural. Again, set up as an LLC. Do you want to be a C corp? Do you have an S corp? What type of business is it? What are you looking to do? Again, these are basic, high-level questions we ask. To at least kind of guide you on what's going to be the best avenue for you to explore. Again, what are your needs? Do you need bookkeeping? Do you have that already in place? A ton of things. Again, we always offer an initial, consultation, say 30 minutes, and that's complimentary. Anything after that, would be fee-based. But again, we don't want people to, I'd rather have someone call me, ask me a dumb question or ask me anything before they just kind of just do it. And then we have to, clean it up, or, excuse my French, for lack of a better terminology, unfuck it. Because, it's very easy to screw things up. And then the cleanup could be a monumental disaster. And then it comes into play where costs and fees and people clean it up. So.
All right. I don't know if I lost him. Do you have a connection, Dave? All right. Other than that, I don't know if I lost you, but I think are you still here?
Yes,
Yes. I don't know what happened. I think my internet reset. I don't know. Apologize.
No, don't worry. AJ, I want to thank you. I personally learned a lot. I'm gonna reach out to you for my tax returns as well, and I hope everybody that's tuned in learned a lot. And AJ's contact is right on the screen. I encourage you guys, like AJ just said, if you're new and you're starting out, give him a call, get a 30-minute consultation, and at least get yourself set up correctly. Because no matter what, you're gonna need an LLC, so you might as well work with AJ on it, and he'll at least set you up so that way you're set up correctly for the the year or the upcoming business plans. And then other than that, if they have questions, and they can reach out to you on the contact information on the screen. Other than that, I want to say thank you so much.
Thank you for having me. Appreciate it.
Guys, if you liked it, share the video and press the like button. Thanks, guys.
All right, guys. Thanks.
Bye.
Bye.